How subscription businesses quietly print money. There is a category of business that, once you understand how it works, you will never look at a monthly charge the same way again. You already pay several of them. You have seen these companies. You probably pay several of them right now. Netflix, Spotify, Adobe, Salesforce, your gym, your cloud storage, your news app, your password manager. On the surface, they look like ordinary companies selling a product or a service. But underneath the revenue model, something structurally different is happening, something that gives these businesses an almost unfair financial advantage over the companies competing against them. A structural financial advantage. This video is about that advantage. We are going to break down exactly how subscription businesses generate cash, why their economics become more powerful over time, what metrics actually matter when you are evaluating one, and why Wall Street tends to assign them premium valuations, sometimes to a degree that looks irrational until you understand the math. No hype, no buzzwords, just the mechanics. The fundamental problem with selling things. Imagine you sell a product, a good one. People love it. You sell 10,000 units in January. Congratulations. Now it is February. February starts at zero. February starts at zero. Every month, every quarter, every year, you start from scratch. You have to find new customers, run new campaigns, close new deals, and spend money doing it. Your sales team has quotas that reset. Your marketing budget gets burned acquiring customers you may never see again. This is the structural reality of a transactional business. Revenue is episodic. Costs are constant. Now imagine instead that your customers pay you every month just to keep using what they already bought. January's customers are still paying in February and March and next year. Your revenue from existing customers does not go to zero. For subscription revenue compounds. It compounds. This is not a minor operational difference. It is a fundamentally different financial architecture. In a transactional business, growth requires constant reinvestment in acquisition. In a subscription business, growth is additive. Each new subscriber layers on top of the revenue from every previous subscriber. If you can hold your customers, your baseline revenue grows automatically without additional sales effort. This is why investors, once they understood this model, began paying extraordinary multiples for subscription companies. It is not about being trendy. It is about the math. Recurring revenue and why it changes everything. The financial term for this is recurring revenue. Specifically, monthly recurring revenue, or MRR, and its annualized version, annual recurring revenue, or ARR. MRR, monthly recurring revenue. ARR, annual recurring revenue. These metrics are the heartbeat of any subscription business. They are not the same as revenue in the traditional accounting sense. They specifically measure the predictable, contractually committed portion of revenue that the business can expect to collect going forward. Here is why that distinction matters enormously. A company with $50 million in annual transactional revenue wakes up every January not knowing how much of that will repeat. It might be 30 million. It might be 60. The range of outcomes is wide, and the uncertainty is real. Transactional revenue starts at zero each year. A company with $50 million in ARR wakes up every January knowing, with high probability, that most of that revenue will recur. The starting point is not zero. It is somewhere close to 50 million, plus whatever they add. The business is not guessing at its baseline. It knows it. ARR starts near last year's number. This predictability changes everything downstream. It changes how the company plans its hiring. It changes how it manages its supply chain. It changes how it communicates with investors. It changes how it can invest in growth, because you can make long-term bets when you know your floor. Banks and credit markets understand this too. Subscription businesses with strong ARR metrics can often access debt on better terms than their transactional counterparts because the revenue stream is treated almost like an annuity. You are not lending against hope. You are lending against contractual cash flow. The cost of buying a customer. Every subscription business has to acquire customers, and acquiring customers costs money. Sales teams, marketing campaigns, free trials, referral bonuses, partner commissions. All of it adds up to a number called Customer Acquisition Cost, or CAC. CAC, Customer Acquisition Cost. The fundamental question every subscription business has to answer is, how much revenue will a customer generate over their lifetime, and how does that compare to what we paid to acquire them? This is the customer lifetime value to CAC ratio, LTV to CAC, and it is one of the most important numbers in the subscription economy. LTV to CAC, the ratio that determines everything. Here is a simple example. Suppose a software company spends $400 to acquire a customer who pays $50 per month. If that customer stays for 2 years, the company collects $1,200 in gross revenue before churn. If the gross margin on that revenue is 80%, the company generates $960 of gross profit from an initial investment of $400. CAC, $400. Revenue, 2 years, $1,200. Gross profit, $960. LTV KC ratio, 2.4 or. That is an LTV to KC ratio of roughly 2.4 to 1. Good, but not exceptional. Now suppose the customer stays for 4 years instead of 2. Same acquisition cost. Now the company generates $2,400 in revenue, $1,920 of gross profit for an LTV to CAC ratio of almost 5 to 1. The 4-year customer, LTV CAC ratio nearly 5x. The implication is crucial. In subscription businesses, retention is not a customer service metric. It is a financial return metric. Every additional month a customer stays, the original acquisition cost becomes more profitable. This is why the best subscription companies obsess over churn, the rate at which customers cancel, more than almost any other number. Churn, the silent killer and the hidden multiplier. Churn is the rate at which subscribers cancel. Churn, the rate at which subscribers cancel. Let us look at the math clearly. If a company has 1,000 subscribers paying $100 per month and experiences 2% monthly churn, they lose 20 subscribers per month. After 12 months, assuming no new acquisitions, they have roughly 785 customers. They have lost more than 20% of their base in 1 year from 2% monthly churn. 2% monthly churn, wind to roughly 22% annual churn. That same churn rate annualized is approximately 22%. To simply maintain a flat subscriber count, they must acquire enough new customers each month to replace those 20 lost ones, just to stand still. Conversely, a company with extremely low churn, say 1% per month, retains over 88% of its base after 12 months without adding a single new customer. 1% monthly churn or 88% annual retention. But here is where it gets interesting. The most sophisticated subscription businesses do not just minimize churn. They actively generate more revenue from existing customers over time through upsells, seat expansions, tier upgrades, and usage-based billing. When this effect is large enough, something remarkable happens. Net revenue retention, the metric that separates good from great. Net revenue retention, or NRR, measures how much revenue a subscription business generates from its existing customer base in a given period compared to the prior period, after accounting for both churn and expansion. NRR, net revenue retention. If a company starts the year with $10 million of ARR from its existing customers, and by the end of the year, without adding any new customers, that cohort is now generating $11 million because some customers upgraded, bought more seats, expanded their usage. The NRR is 110%. NRR above 100%, growing without new customers. A company with NRR above 100% is growing even if it never acquires a single new customer. Think about what that means. The business is not running on a treadmill. The base itself is growing. New customer acquisition becomes a pure accelerant on top of an already expanding foundation. This is what people mean when they describe elite subscription businesses as having a compounding flywheel. The revenue grows faster than the customer count because each customer relationship becomes more valuable over time. Salesforce, NRR historically above 120%. Snowflake, NRR above 130%. Salesforce historically maintained NRR above 120% during its high-growth years. Snowflake, the cloud data company, reported NRR above 130%. In practical terms, this means that even if these companies stopped all sales and marketing activity, they would still be growing from their existing customers alone. This is the clearest illustration of why subscription businesses can appear to print money. The revenue does not just persist, it expands, and it does so largely automatically through normal product usage and business growth on the customer side. Gross margins and the economic engine. None of this works without strong gross margins. Gross margin, revenue minus direct delivery costs. Gross margin is the percentage of revenue remaining after you subtract the direct costs of delivering the product or service. For a physical goods company, this includes manufacturing, shipping, and materials. Gross margins in retail might be 30 to 40%. Retail gross margins, 30-40%. Software subscription businesses have a dramatically different cost structure. Once the software is built, the marginal cost of serving one additional customer is very low. Servers are cheap and shared. Customer support can be systematized. The code does not need to be rebuilt for each new user. As a result, mature software subscription companies routinely achieve gross margins of 70 to 80% or higher. Software subscription gross margins, 70-85% apply. This means that for every $100 of revenue, $85 flows through to cover operating expenses and, eventually, profit. This is why subscription software companies, when they achieve scale, can generate extraordinary free cash flow. The incremental cost of serving each additional customer is so low that revenue growth translates almost directly into profit growth. This dynamic also explains the investment strategy many of these companies pursue in their early years. Because the long-term economics are so strong, it often makes rational sense to operate at a loss early on, spending aggressively on sales and marketing to acquire customers whose lifetime value will far exceed the cost. The losses are not waste. They are investment in future recurring cash flows. The valuation premium and why it is not irrational. All of these structural advantages flow into how subscription businesses are valued, and this is where many investors get confused. A traditional business might trade at 15 to 25 times earnings. A high-quality subscription software business might trade at 10 to 30 times revenue. Not earnings, revenue. Traditional business, 15-25x earnings. Subscription software, 10-30x revenue. This can look absurd until you model the long-term cash flows correctly. Here is the logic. A subscription business with 75% gross margins, 120% NRR, and 15% monthly new customer growth is not really a revenue stage business. It is a compounding machine in the early phase of its cycle. The revenue today is the seed. The cash flows it will generate over the next decade are the harvest. Revenue today is the seed. Cash flows are the harvest. Discounted cash flow analysis, when applied properly to these businesses, can justify significant revenue multiples. The challenge is that this analysis is highly sensitive to assumptions about long-term churn, competitive dynamics, and market size. Small changes in those assumptions produce very large changes in valuation, which is part of why subscription company valuations are volatile. It is also worth noting that not all subscription businesses deserve premium valuations. A subscription company with poor NRR, high churn, low margins, and weak product market fit is not a compounding machine. It is a leaky bucket. Not all subscription businesses deserve premium valuations. The subscription model is a financial architecture. Like any architecture, it only performs well when it is built on the right foundation. What makes a subscription business sustainable? So what distinguishes the businesses that genuinely print money from those that merely appear to? The first factor is switching costs. Factor 1, switching costs. The best subscription businesses are deeply embedded in their customers' workflows. Enterprise software that integrates with your HR system, your financial data, your supply chain, ripping it out is expensive, risky, and disruptive. This is structural stickiness. It is not loyalty born of affection. It is loyalty born of switching being harder than staying. The second factor is data network effects. Factor 2, data network effects. Some subscription businesses become more valuable to each customer as more customers use the platform. A security company that processes threat data from 10 million endpoints sees threats faster and more accurately than one processing data from 10,000. Each new subscriber makes the product better for existing subscribers. This is a compounding quality advantage that becomes nearly impossible for competitors to replicate. The third factor is pricing power. Factor 3, pricing power. Subscription businesses with strong product market fit can raise prices over time without significant churn. This directly improves NRR and gross profit without any additional acquisition spending. Adobe moved its entire suite from perpetual licensing to monthly subscriptions in the early 2010s, a transition that initially met customer resistance but ultimately proved transformative. The company now has far more predictable, expanding revenue from a customer base that is deeply embedded in the product. The fourth factor is the customer success function. Factor 4, customer success. In transactional businesses, the sale is the finish line. In subscription businesses, the sale is the starting line. Companies that invest seriously in helping customers get value from their product, onboarding, support, proactive outreach, usage data analysis, consistently show lower churn and higher expansion revenue. Customer success is not a cost center in this model. It is a revenue-generating function. The subscription economy is not a trend. The subscription economy is not a trend. It is a structural shift in how businesses are built, financed, and valued, driven by a set of economic mechanics that, once understood, are difficult to unsee. Recurring revenue compounds. Low churn preserves and extends the value of every dollar spent on acquisition. Expansion revenue turns the existing customer base into a growth engine. High gross margins mean that scale translates directly into cash flow. And when all of these factors combine in a well-run business, the result is something that looks, from the outside, almost like it is printing money. Recurring revenue compounds. Low churn extends the value of every acquisition dollar. Expansion revenue grows the base automatically. High gross margins convert scale into cash flow, because in a sense it is.